So last time we were talking about the Baldwin example, and we had talked about the number of balls per year that they were going to produce. Where do you think they get this projection, these numbers of balls? What group do you think produced that? Do finance people come up with projections like that? No. It came from that marketing survey, the one they paid $250,000 for. So the marketing survey gives you quantities and price points. Now, here's what I know about marketing people. Unlike finance people, marketing people are optimists. We tend to be pessimists, they tend to be optimists. And I had a marketing guy named Bob. And Bob was always 25% too high. So if Bob told me it was 125,000, I'd say great, and then I'd go around and I'd write 100,000 because he was always 25% too high. And it was consistent, and that's great as long as you know to have that factor in there. By the way, accountants. Do you think accountants are optimists or pessimists? They're going to be more pessimistic, right? What about engineers? Oh, hell no. I used to wake up in a cold freaking sweat worrying about these pressure vessels I designed killing people. Now,
don't they usually just over-design it?
Oh, yeah.
They make a safety factor of like 20.
Exactly. And if you're not doing an airplane, that's perfectly fine. And so airplanes, the problem is they're too heavy to fly, right? Okay, so what does that mean for numbers you get from engineers? They're going to be on the pessimistic side. If they think it's going to cost $100,000 to build, they'll quote you $125,000. Does that make sense? So finance is a social science. You just need to know what side of the spectrum of these people are on. Okay, so we've got both those price numbers. The cost numbers probably came out of accounting and engineering, so they're probably going to be pessimistically high. The prices will be optimistically high. We're not going to make any adjustments for it here, but as you get out into the workforce and you start to encounter these people, hopefully you remember this conversation that we had today. So let's start here by coming up with our unit cost, not unit cost, unit cost. I'm going to select the bowling ball cost year one. And notice how I'm linking up to that. And that way, if I change that later, it'll change everything down below. Now, for the second one, how am I going to calculate what the unit cost is in the second year? Any ideas? So we've got the cost, and then we've got the cost growth rate. And so the second one's just going to be equal to, I'm going to go back and select that, and then I'm going to multiply by, open parentheses, 1 plus, and then I'm going to select this growth rate. And that's going to give me the correct value for the second year. And if I just hit the enter right then, it's going to give me the right value. But what happens when I try to drag this thing over? It's pulling the growth values from out here because we didn't fix that cell reference. So what we got to do is go back and click on that B9, and I'm going to hit F4. Notice F4 pops in the dollar signs. What do the dollar signs do? Yeah, it fixes the cell reference, right? So then when I drag it over, everything comes over correctly. Now, if I went ahead and showed all the decimal places, you would see that we're beyond dollars and cents here. I could round it off. I'm not going to for sake of time, but you can figure out how to do that if you're so inclined. Now we could figure out the also unit price. And similarly, I'm going to say equal to, and I'm going to select this year one price and pop that in there. And then for year two, I'm going to say equal to the prior year's price times, open parentheses, 1 plus. I'm going to select this bowling ball price growth rate. What button should I hit right now to fix that cell reference? F4. By the way, if you're doing this on a Mac, are any of you Mac people? Good. If you're a Mac person, Google that crap. I'm not going to tell you. I used to be a Mac guy, but I forgot that stuff. What do you think you're gonna run into out in the workplace, Mac or PC? PC. Okay, so now I've got enough information that I can actually calculate some stuff. I can calculate my sales in dollars. How would I get the annual sales?
Production times unit price.
Yeah, so I'm going to say equal to production times unit price. Now, do I have to fix any of those cell references? No, because when I drag it over, I actually want those things to change as we go. So I'm going to drag this over. So now we have, oh, by the way, what do the pound signs mean?
That's not enough.
Yeah, not enough room. And the cure is the old double-headed arrow up here. Hopefully I'm not teaching you anything new, but there's always at least one person who's surprised by that, thinks it's magic. Okay, so now I can also figure out my variable costs. I'm going to call them variable costs. Remember, variable costs are the ones that fluctuate with your amount of production. And so how would I figure out my annual variable cost?
Production times unit cost.
Yeah, production times unit cost. And I'm going to drag that over. And then, just for, because I'm going to save this and hopefully you guys will download it, take it with you and keep it close to your heart forever, I'm going to go ahead and throw fixed costs in here, even though the project does not include fixed costs, because fixed costs are important and we should include them. Fixed costs. Now these are the fixed costs of the project. They're still incremental. We wouldn't have incurred these fixed costs if it had not been for the project. So I don't want you to get confused on that. So I'm just going to put fixed cost up here. And we're going to say it's 0. And then I will just say equal to, boom, F4. I'm just going to copy that over. So then we can calculate our total cost. Any idea what that's going to be?
Variable plus fixed.
Yep, variable plus fixed. Drag that along. Okay. So, what do I need before I can calculate EBIT? Think of the income statement. At the top, you're going to have your revenues, in other words, your sales. And you're going to subtract out your cost of goods sold, which is that total cost that we've got. But what else do you subtract out in order to get EBIT?
Depreciation.
Yeah, depreciation. So we can't get EBIT yet because we don't have depreciation, but we will be getting there. Now, the next thing that they actually talk about here in the project is net working capital. So I'm going to go ahead and we're going to do a separate section on that. I'm going to have a section for each one of those things that we had up on the board last time. OCF, NCS, and change in net working capital. So what do they say about net working capital? It's defined as a difference between, well, we knew that. Like any other manufacturing firm, they find they must maintain an investment in working capital. Management determines that an immediate year 0 investment of $10,000 in the various items of working capital is required. The total net working capital for each subsequent year will be 10% of the sales. Does it make sense that net working capital should be a percentage of the sales? So let's think about what goes into net working capital. We got cash, of course, but we also have inventory. If we're going to support twice as much sales, wouldn't we need twice as much inventory? And wouldn't we have twice as much accounts receivable if we were selling twice as much? And wouldn't we be buying twice as much raw material so we would have twice as much accounts payable? So it makes sense that it fluctuates as a percentage of the sales. Now sometimes they get a little tricky and it's a percentage of the next year's sales. So always be sure to read carefully. But this one just says it's a percentage of the current sales. So we can figure through here, NWC. I'm going to go up here and put NWC year 0 is 10,000. And then insert some stuff. MWC percent sales 0.10. And we'll change that to, there we go. So I will just say equal to, and click on this up here. And then for year one, I'm going to say it's equal to the sales times that percentage that we have up here. But what button do I need to hit right now? Yeah, I gotta hit F4 because we want to fix that cell reference. So when I drag it over, it keeps referencing that same bit. Now notice that 10% of 1,000 or of 100,000 is 10,000. So there's not actually any change between time 0 and time 1. So now we need to figure out the change in net working capital. And so I am going to go up here because the, let's see, insert symbols. The symbol for change is what?
Delta.
Yeah, delta. It's a Greek letter. Hopefully we'll be able to find it here. Greek. You guys see it? Shout out.
Is that it?
That house thing? Oh, there it is. Thank you. Okay, so here's the weird thing. Check this out. Why did it change fonts on me? I've been doing these examples like this since 2003. That bug has been there the whole time. Why, Microsoft? Why? So I'm going to go back and select 11 again, and now we're good to go. Now, for the first year, it's just the amount. But how would I come up with the change in net working capital for the first year?
Subtract.
Yeah, I'm just going to take the current period minus the prior period. And I'm going to roll that over. And it's going to grow up to year 3. But then as our sales decline, now it starts to shrink. So you see the change in net working capital is negative. That's actually one of the 3 big things that we're looking for. So I'm going to go ahead and make it bold. And write this up here just so we all remember where we're going. OCF minus NCS minus the change in net working capital. So we've already got that one. Okay, so we've got that taken care of. I think we should start looking at the assets now. And so we're going to have another set of years that I'm going to set up down here. And we've got 2 big assets that we're going to have in this project. What are they?
The machine and the building?
Yeah, the machine and the building. Let's start with the building. It's the easy one. The building is going to be starting out equal to, and it's that building value is an opportunity cost. I'm going to click on that. And then we make the assumption that we get that money back at the end. So all I have to do is say equal to negative and then click over here. And because that's all still linked up, we're perfectly fine to do that. The other thing we have is the bowling ball machine. And we know that in year 0, it is, oh, not year 0. Yeah, it's year 0. It's $100,000, so I'm going to link to that. And then, what kind of cash flows happen for the bowling ball machine in years 1, 2, 3, and 4? Nothing, right? Nothing happens. But at the end, we have the after-tax salvage value, and that's going to be equal to the market value minus the tax rate times the difference between the market value and the book value. So we can't quite figure out our book value yet because we don't know our depreciation. And so we're going to throw something in here called MACRS. We're told that the depreciation on this project is using the Modified Accelerated Cost Recovery System. Is this something you guys have heard of before? Hopefully. It's based on a double declining balance with a half-year convention or some such crap. And they tell us that it's a 5 years MACR. And so we're going to go ahead and put those decimals in there. By the way, notice they start at table 8.3. It starts at year 1. So there's no depreciation at time 0. And they tell us it's a 5-year class. And I want you to notice two things about all of these. If you look at the decimals underneath all of these different recovery period classes, if you add them together, they all add to 1.0, which means that we are depreciating all the way down to 0 in each and every one of these. The second thing that I want you to notice is that for every class, there is one more decimal than the year name of the class. So for instance, for the 3-year class, there are 4 decimals. For the 5-year class, there are 6. How many do you think there are for 15? 16. And we don't even have to count them for 20. We know it's 21. So those are the two things you need to see going on there. And they tell us this is 5 years MACR class. And we'll put in 0.2, 0.32, 0.192, 0.1152, 0.1152, and 0.05. Oh, wait a minute, that's not quite right, is it? What am I missing? Oh, I started one too early. I'll fix it. Here we go. So I guess they're telling you that it's not happening at year 0, and then what did I do? So I'm going to cut that, paste it, move everything over. Now, here's what you need to recognize. Our project is only 5 years long. The MACRS for 5 years actually goes out to the 6th year. Are we going to be able to fully depreciate this asset before the project ends? No. And so that means the book value at the end is not going to be 0. In fact, I could tell you right now what it's going to be. 0.0576 times the value of the machine, $100,000. I'll bet money it's going to be $5,760. But we'll go ahead and prove that. First of all, we'll figure the depreciation. And the way we find the depreciation is by taking each one of these decimals and multiplying by the cost of the bowling ball machine. So I'm going to click right here, but what key do I need to hit right now? Yeah, I got to hit F4. And then I'll drag that over, and that's going to give me all of my depreciation. Then I can figure out my book value. Equal to, we're going to start out with a historical cost, and then for every year after that, we're going to say it's going to be equal to the previous year's book value minus the current year's depreciation. And that was one of the formulas that I had on the board. I'm going to drag that over, and lo and behold, just as we predicted, we're going to have $5,760 worth of book value there at the end. So now I can finally figure out this after-tax salvage value. I'm going to say it is equal to the market value of the book of the machine in year 5, which is this right here, minus the tax rate Ooh, I didn't put the tax rate in. What's the tax rate? They tell us, I know.
21.
21%, are you sure? Oh, you're right. It is 21%. They've changed it on me from one year to the next. Okay, so now we are going to go back here and try this one more time. Equal to the market value of the machine in year 5 minus the tax rate times the market value minus the book value, which is down here. And that should give us the after-tax salvage value. But there's one thing that we need to do here. Remember that when we spend money for capital spending, it's going to be positive money. So this after-tax salvage value coming back to us should be negative. And so I'm going to put in a negative, an open parentheses, and I'm going to go down here and throw a closed parentheses on the other end. Always make sure that you have 2 parentheses. They always come in pairs, right? So if you've got 3 of these, you got to have 3 of these. Okay, now we have enough to figure out our net capital spending. It's just equal to this plus this. And we'll drag that over. And this is yet another thing we're looking for, so I'm going to make it bold. Okay, now do we finally have enough information to go ahead and calculate our EBIT? What was the thing we were missing earlier?
Depreciation.
Yeah, the depreciation. We finally got that. So here's what I'm going to do. I'm going to go up here and I'm going to insert a couple of lines. No, insert. Okay, and I'm going to just copy this depreciation up to here. Oh, undo. Okay, now, how would you go about figuring your EBIT?
Sales minus cost and depreciation.
Yep. It's going to be equal to sales minus the total costs minus the depreciation. I'm going to drag that all the way over. Okay, hopefully you guys remember OCF is equal to EBIT plus depreciation minus taxes. What are we missing?
Tax.
Yeah, so we got to go ahead and figure our taxes. In fact, taxes are the only reason that finance people care about depreciation at all. So we've got our taxes here. That's going to be equal to our EBIT times our tax rate. What do I need to do right now? What button do I need to hit? Yeah, I got to hit F4 so I can fix that cell reference. And then I will drag that over. And so now we can finally calculate our OCF. And we know it is just equal to EBIT plus depreciation minus taxes. And that is the third thing that we're looking for, OCF. Now let's look at the pages that they've given us here. They don't actually give us OCF, do they? They give us net income. Now, how would you handle with net income? Net income already has the taxes taken out of it, but you still have to add depreciation back. And the other part that would usually be subtracted out to get net income would be interest. Have we done anything with interest at all? No. So that's what you'd have to do differently there. Okay, so let's take a look at coming up with the CFFA, which is what we're going to try to discount to get our NPV. So I'm going to do a new set of years down here. CFFA. And it's equal to OCF minus net change, net working capital change, minus the NCS. And so it's negative 260,000, and then we'll drag that over. Come on. Okay, so those should be the numbers that we're going to be discounting. And if you look at in table 8.1, apparently we've got something wrong. So we've got year 0 corrected, negative 260. We've got 43,700, 59,808, 7,934. Okay, so at the end, what could we have wrong that we are $13,000 short over here? I can tell you exactly what it is. What was our assumption about net working capital? What happens to it at the end?
Goes to 0.
Goes to 0. And so now everything is as it should be. So I'm going to save that. Now, how are we going to find the net present value for this thing? Well, it turns out that we have an NPV function in Excel. Did you guys know that? Did you also know that it doesn't work right? We're going to have to make an adjustment for this. First, we'll start with the rate. And they don't actually give us a rate here. They give us different rates, and then they give us some numbers for those rates. And so I'm just going to start with 4%. And then we'll calculate our NPV, and we'll change that rate to make it happen. So I'm going to use the NPV function. I'm going to say equal to NPV, open parentheses. And the first thing it asks for is the rate. And so I'm going to click on this cell right here, and then I'm going to put in a comma. And the next thing it says is value 1. And it's important that it's asking for value 1. Did you notice it's not asking for value 0? So the NPV function in Excel doesn't give us NPV. What it gives us is the present value at time 0 of a series of cash flows starting at, that didn't work right, starting at time 1. There we go. By the way, I could have gone C42, comma, D42, comma, E42, comma, F42, comma, G42, but it would have been a waste of my time. Now, what do I have to do to actually turn this thing into NPV? What's missing?
Subtract times 0.
Yeah, we got to subtract times 0, but our times 0 is already negative, so I'm just going to add it. And that gives us $155,809, which is really, really close to what they came up with. In fact, it rounds to what they've got there. Now, what about if we changed it to 10%? We've got 78,532.76, which is once again very close to what they've got. And then they put in, they say, well, wait a minute, at 1854, you get 0. But is it truly 0? what do we call the discount rate that makes NPV equal to 0? Yeah, the IRR. So what are they saying the IRR of the project is? 18.54%. Now, there are two reasons that our number's not coming out exactly 0 at this point. Number one, remember we did not we didn't do dollars and cents. So we have decimals out beyond the cents. That's the first reason. The second is, I doubt it's truly 18.54. It's probably 18.53769 and a bunch of other stuff. And so those are the two reasons that this doesn't come out exactly 0. How in the world would we figure out what is our IRR? Well, I would actually use the IRR formula, and the IRR formula is a whole lot better. It's exactly what you think it would be. I'm just going to select all of these cells and put the parentheses there at the end, and sure enough, it comes out. But is it really 19%? No. And so I'm going to do a trick like this, and we can see it's actually 18.543207, blah, 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 right? So how could I make sure that's true? I'm going to make this one equal to this cell here. What the hell? There we go. What does the little line mean in accounting? 0. So that's how we would do that with the IRR. And then, of course, we would put in the 20 and figure out that we've got a negative $10,682.05. So basically, we would accept this project as long as the discount rate was less than 18.543, right? But we would have beforehand figured out what is the appropriate discount rate for this project using the techniques that we learned in Chapter 12. Any questions? Should you always trust the computer? Anything on this planet, I want you to remember this from this day forward. Don't trust anything on this planet. So how should we check to see if this is actually working correctly? Yeah, the financial calculator. So get your calculator out. CF, second, clear work. What would we put in for CF0? Yeah, 260,000. Negative, enter, arrow down. So what's C01?
43,700.
Yeah, 43,700. Enter, arrow down. What's F01? 1. In fact, all of these frequencies are going to be 1 because none of the numbers repeat. The next one is 59808. Enter, arrow down, C0377934.24, enter, arrow down, C0468686.5, enter, arrow down, and then at the end we have 231,769.19, enter, and I don't have to arrow down there, but I will just to make sure that I got everything cleared out previously, and I do. So now I'm going to hit NPV, and let's put in that 20% that we've got already, 20, enter, arrow down, compute. I'm getting $10,682.05, which is exactly what we had with our computer, so we should be fine there. Now, we can also check our IRR, compute, and we come up with exactly the same number. Any questions? Okay, I will save this spreadsheet. Then what I want you to do is put it on a USB drive and wear it like dog tags around your neck. And then years from now, when you finally get to the point of being able to do this sort of stuff or having to do this sort of stuff, you'll say, ah, and you won't have to start from scratch. You can just pull this up and work with it. So I will post this all in our Brightspace. Questions? Okay, well, let's get back to our slides. And the first thing we're going to talk about is inflation and capital budgeting. So we've, hopefully you guys remember nominal and real. Nominal, it deals with the units of currency you're going to be receiving. So if I'm getting a 10% nominal return, if I invest $100, I will be getting back 110 at the end of the year. And now it doesn't say anything about my ability to consume. In fact, if inflation in the meantime had been 20%, I would have less ability to consume at the end than I did at the beginning, even though we have more money. Does that make sense? Now let's compare that with the real rate of return. The real rate of return talks about your ability to consume. If I had enough money for 10 pizzas at the beginning of the year, and I invested that money, and at the end of the year I had enough money for 11 pizzas, I would have a 10% real return. 11 pizzas minus 10 pizzas divided by 10 pizzas gives me 10%. Now, did I mention anything about currency? No. And so this real rate of return is not impacted by inflation. Now, how are these things related? They're related through something called the Fisher effect. The big R is the nominal rate. The big R is the nominal rate. And by the way, this is called the Fisher effect. It's the name of this formula. You usually see it written a little differently, but I like to do it this way to make it easier for you guys with the math. Okay, we've got little r over here. Little r is the real rate. Little r is the real rate. What do you think H stands for? Inflation. Why do you think we don't use I for inflation? What else could I stand for in finance?
Interest.
Yeah, interest. So we're not going to do that to try not to confuse you. Now, you may also see this written as pi. In fact, if you guys take any classes with Dr. Whitty, he will use the Greek letter pi for inflation. When I say pi to you guys, what do you think? 3.141 blah, 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 right? That's why I don't use pi. That's why I use H for inflation. Okay, now what does this mean? It means if I have any two of those, I can figure out the other one simply by arranging that formula to solve for the other thing. What we see in our capital budgeting is that if we are looking at nominal cash flows, then we should discount those at the nominal rate. If we are using real cash flows, in other words, ones in $0, then we should discount those at the real rate. And you will always get the same net present value as long as you discount real with real and nominal with nominal. It doesn't matter, and here's why. Let's say the present value is equal to the future value divided by 1 plus r to the t. Now we've got, I'm going to use future value in nominal as capital FV. and future value in real terms, I'm going to use a little FV. And this is the nominal rate. So we're taking a nominal value here and discounting at a nominal rate. Now, how do I get that nominal value? Well, I'm going to take the real and multiply by 1 plus h to the t power, because inflation is just like interest, it compounds. And down here on the bottom, I'm going to have 1 plus r to the t times 1 plus h to the t. Now, most Americans wouldn't know the answer to this, but I'm going to ask Mr. Bardwash. Mr. Bardwash, have I done that correctly? Yeah. Okay, so now here's the fun thing. What happens to the 1 plus h to the t terms? Yeah, they cancel out. And so if we take a real amount and discount it at the real rate, we get exactly the same thing as taking the nominal amount and discounting it at the nominal rate. If I give you 27 nominal numbers and 1 real, should you convert the 1 real to nominal or the 27 nominals to real? Yeah, I would convert the 1 for 2 reasons. 1, I'm lazy. And 2, it's only 1 opportunity to make a mistake instead of 27 opportunities to make a mistake. What happens in practice? Every single one of these analyses that I did in industry, we always used the nominal, and then there's the nominal rate. By the way, that rate that we found in chapter 12, was that real or nominal? It's nominal. Any rates that you observe out in the wild are nominal. So when you see down at the bank that they're offering 4% on a CD, that's a nominal rate. If you want to know the real rate on that, you're going to divide by 1 plus h. So you have 1 plus r, divide by 1 plus h. And that's going to give you 1 plus little r. So it'd be 1.04 divide by, if it was 2% inflation, 1.02. And that would give you 1 plus little r. Okay. Any questions about how we handle inflation in capital budgeting? If I have nominal cash flows, what do I discount at? Yeah, and if I have real cash flows, what do I discount at?
The real rate.
Real rate. And what kinds of rates do we observe out in the wild, real or nominal? Nominal. Very good. Yeah, we've already taken care of that. Okay, so now we're on to talking about investments of unequal lives. We're talking about, we're looking at 2 different machines, and they both fulfill the same need. They both produce the same revenue. So all we're really interested in is the cost. And if they both had identically the same, what the hell? We'll get that started back up here in a second. If they both had identically the same lives, all we would have to do is take the present value of all those expenses that were involved with them, so the initial cost of buying them plus the maintenance costs, and compare those. But when they have different lives, then we have to figure out a different way to do that. And the way we're going to do that is by calculating something called the effective annual rate. So for example, I might have, I'm going to have 2 different lives here. We're just looking at the costs. What I'm going to do is I'm going to take all the costs associated with the project, and I'm going to crush them back into a single number at time 0. That's the first step. And the second step would be to find an annuity that has the same life as the machine and the same net or the same present value of expenses. And so basically what we're doing is coming up with an annual amount that happens every year of the machine's life that is equivalent to the actual cost of the machine. We're going to do that to both machines. And that's going to give us what's called an effective or equivalent annual cost. If I give you one machine that's costing $80,000 per year equivalent annual cost and another one that's costing $100,000 a year equivalent annual cost, which one would you choose? Oh, come on, you guys know this. You went to MSU because it's cheap, right? Yeah. Yeah, you choose the lower cost alternative, and that's what we're going to do here. Always trust your greedy heart when you read these questions and wonder which one to choose. So let's do an example here. The example here is the tennis ball throwing machine at the country club. Do you guys know what a country club is? Mr. Buat, what's a country club? Golf. So that's one of the activities at the country club. Let's be a little more specific for those of you who might not have grown up around the situation. The country club is where rich people go to get away from poor people. How do they keep the poor people out? Yeah, the membership costs. You got to keep the membership costs high enough to keep the poor people out. And so that's the country club. Now, the country club, in exchange for this exorbitant amount of money that they pull in, they provide activities like golf, swimming, tennis, drinking, and eating. Those are your big 5 activities at the country club. Now, I just mentioned tennis, and one of the popular misconceptions about rich people is that they all have friends. It's not true. There are some rich people who have no friends who are willing to play tennis with them. As a result, the country club must invest in a tennis ball throwing machine to play with these unfriendly rich people. And so that's what we're trying to do here. Our old tennis ball throwing machine is worn out. We're looking at replacing it. And there are 2 possibilities for replacing it. First of all, we have machine A. Machine A has an upfront cost of $500 and then will cost us $120 a year in maintenance. And after the end of year 3, it dies worthless and we have to replace it. Machine B, on the other hand, costs $600 up front. It has lower maintenance costs of $100 per year, and it lives for 1 more year. So it lives 4 years and then it dies and must be replaced. Just looking at the numbers right now, can you choose the most cost-effective one? Which one does your heart tell you? Captain Barentine.
I would do probably A.
Probably A. Most people will go with that because it has the lowest upfront cost. Actually, what we find out is depending on the discount rate, either one of those could be the way to go. And here's the way to think about it. If the discount rate is high enough, then really only that first cash flow matters because the present value of all those future cash flows is just so darn low. But if the discount rate is low enough, then perhaps B would be the better way to go. The only way to find out is to do the math. And so we get out our calculators and we say CF, second, clear work. And the first thing I want to point out to you is that all these cash flows are costs. So we're going to have the same sign on all of them. Typically, we would have put a negative on all of these, but you know what? I'm lazy. I'm going to make them all positive. I'm going to say 500 for the first cash flow, or CF0. And then I'm going to arrow down. What would C01 be for project A? 120, very good. 120. Enter, arrow down. What's F01? 3. Enter. Now I can use the NPV function. Because remember, all NPV function does is sums up the present value of all the cash flows, including the time 0. So I'm going to hit the NPV button, and they tell us that the required return is 10%. So I'm going to put in 10 here, enter, arrow down, and compute. The present value of that initial investment plus those 3 years of maintenance is equal to $798.42. That's the first step. So here's what I'm going to do, just in case things go terribly wrong. I'm going to hit store 1. And then I'm going to hit clear a couple of times just to get that number by itself. And then I'm going to say second and hit the future value key. What does that do? What does second future value do?
Clears all your.
Yeah, it clears all the values out of these time value money keys. So I'm going to now put this in for present value because that, after all, that's what it represents. I'm going to put in 10 for I per Y because after all, we're told we got a required return of 10%. And then I'm going to put in the number of years this thing is alive. It's alive for 3 years, 3, N, and then I'm going to compute payment. And so the equivalent annual cost for machine A is equal to $321.06. In other words, the present value of 0, 321.06, 321.06, 321.06 is exactly the same as 500, 120, 120, 120. That's what that means. Okay, let's do the other one. So I'm going to hit CF, second, clear work. And the other one starts with a 600 upfront investment, enter, arrow down. What's C01? 100. Enter, arrow down. What is F01? 4. Very good. 4. Enter. NPV. Once again, the required return is 10. Arrow down. Compute. That is the present value of all those cash flows for B. Now I'm going to store that in location 1 just in case everything goes horribly wrong. And I'm going to hit clear twice. Then I'm going to hit second, clear TVM. What button should I hit next? What does this number represent? Yeah, it's the present value of those cash flows. So I'm going to put it in as present value. What should I put in for N? 4, and it's a 4-year life. 4, N. What should I put in for I per Y? 10, I per Y. And what should I compute to get the equivalent annual cost? Yeah, compute the payment. And it's telling us $289.28. So we're getting exactly the same thing per year from machine A for $321.06 or from machine B for $289.28. Which one of those would you choose? Yeah, you always choose the cheaper one. So that's how we're going to handle these investments of unequal lives. It's through this thing called equivalent annual cost. And in fact, we're going to use that again on the general decision to replace. This is the most common decision made in finance, and that is the decision of when to replace a piece of equipment. So here's what happens with equipment as it gets old. When you first buy the equipment, there is probably very little in the cost of maintenance. Let's use a car, for example. If you buy a brand new car, the first year, probably the only thing you have to do is change the oil and maybe change an air filter, but it's pretty minor. But over time, things start to wear out and you have to replace more stuff. For instance, brake pads. After 3 or 4 years, you probably have to replace brake pads. You probably have to replace tires down the road. And then some of the major components start to wear out. Things like alternators or air conditioning units. Those conk out and you have to spend more money to replace them. So your maintenance costs on machines go up over time. At some point, those maintenance costs get so high that it is worth just replacing the machine with a new machine that has lower maintenance costs. And the general decision to replace is how we go about deciding at what point do we pull the trigger and get the new machine and kick the old one to the curb. So how are we going to do that? We're going to do 2 analyses. The first analysis is we will look at the proposed new machine, and we will calculate an equivalent or effective annual cost for the new machine. And then we are going to examine on a year-by-year basis the cost to hold on to the old machine for 1 more year. And when that cost to hold on to the machine for 1 more year exceeds the equivalent annual cost, that's when we will replace the machine. So of course it's best to do it with an example, and our example here assumes that the revenue is the same from both machines. I'm going to tell you that's probably not correct, because new machines, in addition to having lower maintenance costs, are probably more productive and therefore can produce more revenue. But just for sake of this discussion, we are going to assume that the revenue is the same for both. So the first bullet point deals entirely with the new machine. The new machine costs $9,000. It requires $1,000 per year in maintenance, and it has a life of 8 years. And the salvage value is $2,000 at the end of its life. We're going to assume that's the after-tax salvage value. So I need to use that information to figure out an equivalent annual cost for the new machine. So I'm going to get my calculator up here. I'm going to say CF second, clear work. What should I put in for CF0 for the new machine? Mr. 9,000. Enter. Arrow down. What should I put in for C01 of the new machine? 1,000. Enter. Arrow down. What should I put in for F01? Everyone wants to say 8, but the actual answer is 7. 7. Enter. Why is it not 8?
In year 8, you have the salary.
Yeah, so in year 8, we've got the 1,000 in maintenance that we've had every other year, but at the end of that year, we sell the machine and get 2,000 back. So that's a negative cost. And so that last year is going to have a value of negative 1,000. And so I'm going to put in 1,000 here. Negative. Enter. And then what would I do? My first step to figure out the EAC for this. It's exactly what we just did. Yeah, we're going to go at NPV, and we're going to put in our required rate of return, which is 15%. 15, enter, arrow down, compute. So I'm getting $12,833.52. Now, that's just the first step. I'm going to store 1 in case something goes horribly, horribly wrong. I'm going to clear twice here. What's the next thing I should do?
Figure that is your present value.
You're skipping 1 step. Second, clear your TVM. You don't know what else is hanging out in there waiting to give you trouble. So we're going to clear that out, and he's absolutely right. We're going to hit this into our present value. What should I put in for I per y? 15. And what should I put in for n? 8. We're going the full 8 years here on the life, so don't let that last weird cash flow fool you. Okay, now what do I compute? Yeah, compute the payment. And that tells us the equivalent annual cost of the new machine is $2,859.95. I'm going to erase all this garbage so we can start fresh. So we've got EAC of the new machine is equal to $2,859.95. Is that correct? Yeah. Okay. Now, that's our benchmark. And what we're going to do is look at the old machine, and the first year in which it's going to cost us more to hold on to the old machine than $2,859.95, that's when we're going to replace the machine. So let's look at the information we have on the old machine. We have 2 columns here. We have the maintenance per year, and we have the salvage value. And so we're looking at the current time, 0 maintenance. If we could sell the machine right now, we would get $4,000 for it. If we wait another year, we're going to have to pay $1,000 in maintenance, and the salvage value would only be $2,500 at the end of the year. If we go on to year 3, the maintenance goes up to $3,000, but the salvage value comes down to $1,000. And if you go to year 4, your maintenance is going to go up to $4,000, your salvage is going to go down to 0. Does it make sense that as a machine gets older, the maintenance cost is going to go up? Yes. Does it make sense that as a machine gets older, the salvage value is going to go down? Yes. Now, where would you get these numbers? Well, so let's talk about the salvage values. There are 2 places I can think of to get salvage values. There's the old school way, which would have been what I did back in the day, and that's to get a hold of my machine dealer, Rusty, and ask Rusty to give me a quote on the machine. And he'll come in and he's going to look at the machine and he's going to run the controls, he's going to smell it, he's going to do all sorts of dealer kinds of things, and he's going to say, I give you $4,000 for it today. And I say, great. Now, what if I run it for 1 more year, running aluminum, 2 shifts a day, 8 hours per shift, 5 days a week? And the reason I have to tell him aluminum is because the material matters for how much it wears the machine out. Aluminum's easy to cut. Steel is harder, and if I were doing some sort of high nickel alloy, it wears the machine out even faster. And so he says, well, I hate to say it, but if I had to guess, I'd say $2,500. And so far I've only pissed him off in a minor way, but now I'm going to ask him, well, what if I did that for 2 more years? And he'll say, $1,500, and then he gets even madder, and I ask him for the 3rd year, he says $1,000. And by the time I get to year 4, he says, I wouldn't give you a damn thing for it. That's where we get 0. So that's one way. The more modern way would be to go out and find machines that are the same age and condition as yours. So that would be your time 0 value. You can go out on the internet and find those. Now, would you be able to sell it for the same amount that the people on the internet are selling? No, it's like bid and ask, right? And so you're going to have to figure out what sort of markdown. Just roughly, I would say 80%. So if they're selling their machine for 10,000, you can probably get 8 from a dealer for yours. Okay, now find one that's 1 year older and use that for your year 1. One that's 2 years older, use that for your year 2, and so forth. So that's the way to get the salvage values. Now let's talk about maintenance numbers. If you go to work in an organization that has any size at all, it will have a maintenance department, and the maintenance group, one of the things they do is keep records. And so they'll be able to pull up on the computer and show you what you've spent on that machine over the last year, over the last 5 years, and so forth. And they can use that kind of information to come up with maintenance cost forecasts going forward. They will also know things like there are weird spikes in maintenance costs. For example, on an airliner, the first 6 years are pretty much the same. In the 7th year, you have to tear the whole thing down to the rivets and inspect it, and you basically rebuild it. And so that 7th year maintenance cost is extraordinarily high compared to the others. If you don't know that, you might predict the 7th year to be much lower than it actually would be. Another example, I had a machine, 237, and every year when I was doing my budgeting, I would walk around with my maintenance guy, Tom, and I would say, okay, this machine, what's going to be going on with it next year? He says, well, you spent $30,000 on maintenance this year. Expect next year for that to be, 10% higher, but you also will need to replace the thrust bearing. I said, why am I going to need to replace the thrust bearing? He says, well, they have to be replaced every 10,000 hours, and this machine is creeping up on it. And so I would say, well, what's that going to cost me? He's like, well, that's $70,000 and 3 days worth of lost production. And so those are the kinds of pieces of information that you can gather together from your maintenance people to come up with these predicted maintenance cash flows out. Now, here's something you need to understand about people. People are rationally self-interested. I like to say they're scumbags, but the correct economic term is rationally self-interested. So, maintenance people, do you think, being rationally self-interested, they would prefer old machines or new machines? Everyone wants to say new, but if I had a whole bunch of new machines, how much maintenance work would there to be done? Not as much. And so maintenance people prefer old machines. They don't want me to replace the machine. So they are going to guess low. Does that make sense? In fact, let me give you an example of how this works. When I worked at the nuclear plant, the problems were almost always reported at 4:30 on Friday afternoon. Why do you think the problems were almost always reported at 4:30 on Friday afternoon?
They don't have to deal with it until next week.
It's a nuclear freaking power plant.
Oh.
You have to deal with it, right?
There's probably a weekend shift and someone else coming in that has to deal with it.
No, man. Overtime. You're not thinking like an hourly worker. You got to think like an hourly worker here. What are they going to get once 5 o'clock rolls around? They're going to get an extra 50% per hour, right? OT, baby. I got a bass boat to pay off. And so the operators who were hourly and the maintenance people who were hourly would always report problems at 4:30 on Friday afternoon. Now, another thing you need to know about nuclear power plants is that they're run by old Navy guys, not from the clothing store, from actual people from the Navy, right? And the guy that was in charge of our facility was an old submarine commander, and he would get on the intercom when we'd have one of these things, and he'd say, "All hands on deck!" Now, as an engineer, am I getting paid hourly? No, I'm on salary. And so when they're dragging my ass to the deck at 4:30 in the afternoon, it's done is killed my weekend, right? Now, did they really need me to be there to fix this problem? Absolutely not. And so what we engineers figured out is they would let us flex our time, And on Fridays, we would always come in at 7 and leave at 4. So when the all hands on deck call went out, none of us were there. They didn't need us anyway, right? And so that's what we did. Now, knowing that, maintenance people are basically, they're wanting overtime, so they want these old machines. The other reason that they want old machines is it's job security. If I'm the only guy there that knows how to fix machine 237, how hard is it to fire me? It's really hard, right? Now, what does that mean for how these people behave? They act like total assholes, and they get away with it because no one can fire them. It's so rewarding when you replace a machine that only one person can fix with a new machine that doesn't need maintenance, because what's the first thing you can do? Fire that piece of shit that's been giving you grief for years, right? It's really rewarding. That's one of the benefits. Now, what about another group who could give us these maintenance estimates? How about engineers? They can read the manuals, they know the maintenance, they can read the maintenance intervals, but engineers love new machines. So engineers are likely to overestimate the maintenance costs in order to be able to replace the machine sooner. So what do? You take both sets of these maintenance figures and you average them and probably get somewhere close to the truth. Okay, let's take a look at what goes on here. If I hold on to this thing for one more year, that's going to cost me $1,000 in maintenance, but I'm going to sell the machine at the end of the year for $2,500. That's going to bring money in, so that's why it's negative. But in order to do that, what did I have to forgo at time 0? What was the opportunity cost? Yeah, I couldn't sell it for $4,000 if I held on to it for another year. So that's going to give us an opportunity cost of $4,000, but is it just $4,000? No, it happened one period ago, so I'm going to have to add 1 plus r to the t here, so it's going to be 1.15 to the first power, so you know that's just not there. So that's $4,600. So we got 1,000 minus 2,500 plus 4,600. If my math is correct, I think that's 3,100. Is that right? Does that look right? Oh, Mr. Bardwell, I figured you could do that in your head. So here's how I would go about this. 1,000 plus 4,600 is 5,600. 5,600 minus 2,500 gives me 3,100. That's how I would do that in my head. Okay, now, is this number greater than the effective annual cost of the new machine? Yes. When do we replace the machine? Now. Let's assume, though, just for sake of argument, that it wasn't. Let's assume that was like $2,700. We would go on to the next year. In the next year, we've got $2,000 in maintenance. If we sell the machine at the end of the year, we would get $1,500 back. But what was our opportunity cost to hold it from time 1 to time 2? Yeah, 2,500 times 1.15. What is 2,500 times 1.15?
2875.
2875, thank you. So 2875, 4875 minus this, I'm going to say 3375. Does that sound right? Okay. Now, once again, this number is larger than this number, so we would replace it. Well, the reason I went ahead and did that is so you guys could see how this number here changed, and that it's only one period, because we're going from time 1 to time 2. Now, what your book says is just hold on to it, or you do this analysis and you see what year to replace it in, and then you just make yourself a note. Oh, replace the machine 3 years from now. I'm going to tell you a simpler, better way. And I'm going to tell you that you really only want to get time 0 and time 1 numbers. The further out in time you go, the less accurate the numbers are. So you only want to get time 0 and time 1. And when you figure out that you need to hold on to your old machine for 1 more year, what you do is you get out your iPhone and you set yourself a reminder. 1 year from today, reanalyze machine 237.
And the reason that you do that is because these forecasted numbers can change one year to the next. Machine prices go up. Salvage values, strangely, can change too, depending on what's going on in the market. Any questions?